Welcome back, guys. We're in part 2 of what are the best investments for your 401k right now. And if you guys want to be more hands-off, again, if you want to be more passive, more hands-off, and you want that style of approach to investing for 401k growth, here are the tried and true options. Real estate investment trusts is one. Again, REITs, and private real estate funds. Those are the two popular methods of investing for 401k growth, each with its own unique characteristics and benefits. REITs, they're companies that own and operate income-generating real estate properties, such as shopping centers, office buildings, apartments. There are a litany of different types of REITs for you to peruse, depending upon what you're ultimately looking to achieve. Investors can buy shares in these companies, which are traded on publicly traded stock exchanges, which makes them easy to buy and sell. But I would say one of the downsides is if you're looking for alternative investments and removing some of the capital from traditional vehicles like stocks and bonds, REITs are still correlated to the stocks and bonds. And so they're going to be flowing in terms of the market fluctuations a little bit more similarly as opposed to truly alternative investments like private real estate funds, syndications, or direct ownership in real estate. REITs are required by law to distribute at least 90% of their taxable income to their shareholders as dividends, which makes them attractive to income-oriented investors looking for just very predictable, reliable, passive income over time. One of the benefits of investing in REITs is their potential for diversification. REITs invest in a variety of properties across different geographic locations, which can help reduce the risk of investing in a single property. Additionally, because REITs are required to distribute the vast majority of their income to shareholders, they can provide, again, that steady stream of income that can be reinvested to grow the value of the 401k over time. On the other hand, private real estate, such as syndications or private real estate funds, they're investments which pool capital together from multiple investors to acquire and manage real estate assets. These funds are typically only available to accredited investors who meet certain income and net worth requirements. They're not traded on public stock exchanges. A few of the main benefits of investing in private real estate funds are the potential for higher returns and direct ownership of the assets in the funds themselves. Because they invest directly in real estate, they typically generate higher risk-adjusted returns than REITs, which may be subject to that market volatility that I'd referenced earlier. Since you're pooling your capital together with other investors, you're taking legitimate ownership of the physical real estate. With REITs, you're buying shares of the company that owns the real estate. Additionally, because private real estate funds, they're not publicly traded, they're not subject to the same sort of short-term market pressures that REITs have, which can allow managers inside of the private real estate funds to basically take a more long-term approach to investing. Private real estate funds and syndications have similar diversification and cash flow opportunities, and they provide the potential for higher returns as well. In my humble opinion, private real estate funds tend to be a more attractive option for those that are looking to invest for stability and predictability in alternative investments. Ultimately, a lot of the reason folks are moving away from traditional vehicles like stocks and bonds into, quote, alternative investments through their self-directed IRA or self-directed 401k is to get non-correlated assets. The REITs, they're still correlated to the broader markets. And diversification. When you're investing for retirement, diversification is key. A well-diversified real estate portfolio can help reduce risk and enhance returns. Here are some common diversification strategies for real estate investors that help minimize the impact of a downturn of any single segment of the market. One way to diversify a real estate portfolio is obviously by investing in different types of properties, such as residential, commercial, industrial, retail. Each of those different property types has its own unique characteristics and market cycles, which can help reduce overall risk. At Sunrise, we pay tens of thousands of dollars each and every year to ultimately garner as much institutional data to select the most appropriate asset classes given the current market cycle. You should also hone in on geographic diversification. Investing in properties located in different geographic locations can help spread risk and minimize the impact of local economic downturns. That can include investing in properties across different geographic regions of the country, or even investing in international properties. We haven't gone down that road. We prefer domestic stuff, but again, everyone's situation is unique. You can also diversify through investment vehicles. Investors can also, have a certain percentage of their real estate portfolio allocated to different types of investment vehicles. Maybe a portion is allocated to REITs. Maybe a portion is allocated to syndications. Maybe a portion is allocated to private real estate funds. Ultimately, that's going to help you create a more diversified investment portfolio. You can also have tenant diversification. For example, if you're investing in one individual single-family residential home and the tenant leaves, you have 100% vacancy, and because you have no diversification in your tenant mix, you have 0% income. But if you're in a retail shopping center, let's say you have 6 or 7 tenants, if one of them goes, at least you have maybe 80-ish% occupancy still. Even better, right, in a multifamily property, when you have hundreds of units and one of those residents ultimately leaves, you take a very modest vacancy hit. So that tenant diversification really benefits you tremendously. You should also diversify your financing sources, such as using a mix of different debt and equity in the capital stack, and also potentially using different lenders so as to spread out the risk on the financing side of your business. If ever we have massive increases in interest rates or there's a massive shrink of the amount of credit availability, when you diversify your lending sources, you are in a much more strong position, being able to pivot as needed as market conditions change. You should also rebalance your portfolio periodically. It's crucial for maintaining your target asset allocation and your risk level. That involves periodically adjusting the allocation of investments to maintain a desired level of risk and diversification. Here are some steps to regularly rebalance a real estate portfolio. First, set a target allocation. The first step is ultimately to determine the desired allocation of investments across different types of properties and geographic locations. This allocation should be based on your risk tolerance, investment goals, and ultimately your market outlook. You need to monitor your portfolio. Regularly monitor the performance of your portfolio, any significant changes in the market or the portfolio's composition. You should determine the rebalancing thresholds. You need to establish very specific thresholds and keys that will indicate whether you need to rebalance your portfolio or not. For example, if a particular asset class exceeds or significantly falls below a threshold, a target allocation, by a certain percentage, it may be time for you to ultimately rebalance the portfolio. And once you've ultimately made that decision to rebalance, determine the specific strategy that you should use to ultimately achieve that end goal. That may involve selling some assets that have exceeded their target allocation and using the proceeds to ultimately purchase the assets that are underweight in the portfolio. Finally, after you've made that decision, you really need to execute the rebalancing strategy by basically selling the assets and buying the new ones to bring the portfolio back to its target allocation. It's important to note that rebalancing too frequently can result in higher transaction costs and potentially reduce overall investment returns. On the other hand, if you never go down that path, if you neglect to do so, that can result in a portfolio that becomes too heavily weighted on certain areas, leading to higher risk exposure than that which you ultimately thought you signed up for. Therefore, it's important to find a balance between rebalancing too frequently and just neglecting to do it entirely. To call back the two main tried and true hands-off approaches that we brought forward here, when you invest in a REIT or a private real estate fund, the majority of the work that diversification and rebalancing the portfolio requires, it's really done for you. You're already investing in a diversified portfolio of assets across various different geographic regions. All this is to say that no matter what route you take, you need a long-term investment approach that is essential for achieving sustainable risk-adjusted returns in real estate. Focusing on high-quality assets and strategies that can deliver consistent income and potential appreciation over the long term. We're trying to help as many people as possible generate cash flow and build legacy wealth for them and their families. So we avoid chasing short-term trends or trying to time the market. Instead, you should be focusing on building a diversified portfolio of investments that can weather market fluctuations and provide long-term growth. Now that you know how to use your 401k for growth in today's market, focusing on real estate, you should apply these strategies and tips to maximize your 401k's potential and help you secure your financial future for you and your family. Don't forget to like, comment, and subscribe for more valuable real estate investing content, guys. Enjoy the day.